Warren Buffett almost spent his billions recently, but at the last moment, he backed down. What led the world's greatest investor to nearly contradict his own philosophy? And what could this reveal about how to invest your money going forward? In this video, you will understand the logic behind this choice and how to apply a strategy that goes against everything that 99% of investors believe. During the last Berkshire Hathaway assembly, Buffett, when responding to a question, stated unequivocally, "We came very close to investing €10 billion recently." This remark from someone known for acting with surgical precision, never impulsively, is noteworthy. What stands out is the fact that he almost made the investment and then pulled back. This is something rare in his trajectory. Why did he reverse his decision? The answer was direct and unsettling, because there was not enough conviction. It was not about expected returns or sophisticated technical analysis. The decisive factor was the absence of total clarity. Buffett did not see a robust margin of safety there, which is something he demands in any significant allocation. For him, it is like entering a burning building simply because he heard someone say that there is gold on the top floor. If there is no safe staircase, it is not worth the risk. And if he, with decades of experience and access to information that few in the world have, prefers not to act in the face of doubt, what does that say about the average investor? Consider this. The greatest investor of the century almost made a €1 billion move, but pulled back at the last moment. This not only reveals his caution, but also his philosophy. Buffett prefers to err on the side of inaction rather than rush into decisions. And do you know what is more curious? This decision to do nothing likely preserved billions in value for his shareholders. This stance is anchored in a concept he frequently repeats, the fat pitch, an expression from American baseball that refers to that perfect, easy-to-hit ball. For Buffett, the markets offer these balls rarely, but when they appear, it is essential to be prepared. How can you tell if an opportunity is a fat pitch? What separates a good offer from a well-disguised trap? The signs exist. And in the next section, you will understand how Buffett prepares for this. More importantly, you will learn how you can do the same. Today, Berkshire Hathaway holds more than €347 billion in cash and short-term investments. This represents approximately 27% of all the conglomerate's assets, the largest proportion ever recorded in its history. Why keep so much capital idle while the market presents dozens of apparent opportunities? Buffett, as always, was straightforward. He prefers to be criticized for waiting than for investing without clarity. But why would someone with hundreds of billions available choose to wait, even knowing that he is being criticized? The answer, when you hear it, will change the way you view liquidity. For him, cash is not passivity, it is strategy. A loaded weapon that will only be used when the opportunity is clear, valuable, and secure. And here is the detail that almost no one perceives. This cash is, in practice, a free call option, a right he maintains to act with agility and advantage at the exact moment when others are desperate. And this is not theory. In 2008, while the financial system was crumbling, Buffett entered strongly into Goldman Sachs and other giants, negotiating terms that only someone with cash and courage could demand. In 2020, during the panic of the pandemic, he again bought assets in Japan while most fled from Asian risk. Coincidence? No, it is a pattern. But how to apply this in real life? For those managing a personal portfolio, keeping between 10% and 20% in liquidity may seem counterproductive. But during a market downturn, while others watch their stocks melt away, you can purchase solid assets at a discount. Those who think they are losing money by holding cash often forget that the biggest gain lies in making the right purchase, not in being 100% allocated. Moreover, cash also serves an emotional function. It reduces anxiety. It helps maintain rationality when everything around screams for panic. And this, for ordinary investors, is as valuable as percentage return. But if cash serves as a hidden advantage, there is another stance of Buffett's that contradicts almost everything you hear about investing out there. A strategy that seems inefficient, but could be precisely what generates extraordinary profits. Let's talk about this now. Buffett and Charlie Munger have reiterated this idea for decades. If you make just a few really good choices, you will fare much better than trying to be right all the time. This seems counterintuitive, especially in a world where everything revolves around constant activity. But this is exactly where most people go wrong. Most investors fail because they cannot remain still. They change their portfolio monthly with contributions and make impulsive trades. The more they act, the more they dilute their gains. Buffett has always been the opposite of this. He acts infrequently, but with precision. He does less but demands maximum conviction in each step. Just because you made a contribution or received dividends, it does not mean you need to invest immediately. He is quite practical in thinking that if there are no great opportunities, it is not worth investing at that moment. Instead, it is better to wait for those opportunities to arise. In practice, this translates into three attitudes. First, reduce the turnover of the portfolio to a minimum. Second, only invest when there is absolute clarity regarding the asset. And third, adopt a rational checklist before each decision. Is it a great asset? Does it have a margin of safety? Among other criteria. This type of discipline requires training, but it pays off significantly in the long run. And more than avoiding losses, this strategy creates space to identify truly exceptional moments. However, to take advantage of these rare opportunities, you need to be prepared in a different way. More strategically, more patiently, and above all, mentally ready to wait. And this is what we will explore next. Warren Buffett has lived for more than 16,000 days in the market. That's right. It has been 8 decades observing the daily fluctuations of prices, economic cycles, bouts of euphoria, and periods of panic. And what does he conclude after all this? That only a small fraction of those days truly made a difference in the results of his portfolio. This realization is uncomfortable for those seeking predictability, but it carries a powerful lesson. Extraordinary returns do not occur in a straight line. They materialize in concentrated moments, often unpredictable. Ordinary days go unnoticed, but a crisis or a singular opportunity can define decades of results. And here is the most intriguing part. Even the greatest managers do not know in advance when those moments will come. Buffett states this openly. Ray Dalio agrees. No statistical model, algorithm, or expert can reliably predict the next move accurately. And yet, thousands of investors continue to act as if they know. The rational path is not to predict, it is to prepare. And for that, your portfolio needs to be designed to remain static for 6 to 12 months without the need for intervention. More importantly, you must be able to endure a drop of 15% without rushing to sell everything. But this preparation goes beyond the composition of the portfolio. It also involves an increasingly rare skill, knowing how to wait, and waiting with discipline. Buffett has compared the act of investing to gold prospecting. Most of the time you are digging, waiting, assessing, until, in rare moments, something truly shiny appears. This image is not merely poetic, it accurately describes what defines the best investors: the ability to wait. But not passively, waiting with intention, clarity, and discipline. This is precisely where most fail. The average investor feels pressured to act constantly, and the market fuels this urgency. Notifications, real-time charts, news shouting about unmissable opportunities. But the big names in the market follow a different logic. Howard Marks has stated that the best returns come from decisions made in moments of discomfort. Gerd Kommer, known for his evidence-based approach, reinforces this. The greatest advantage of the average investor is patience. And this strategic patience is directly connected to the concept of anti-fragility by Nassim Taleb. An anti-fragile system not only withstands chaos, but benefits from it. For the investor, this means being structured in such a way that crises and market downturns become opportunities rather than threats. But for this to work, one must avoid a very common mistake: acting out of impatience. Here lies a simple yet powerful rule. Before buying any asset, seek 3 confirmations. Does it have real value? Does the context favor this decision now? Is the risk clearly under control? If any of these answers is, I don't know, it may be better to continue waiting. Staying still is not wasting time, it is gaining an advantage. While others run in circles, the disciplined investor positions themselves. And when the right moment arrives, they act with clarity, while others are still recovering from their last mistake. However, there is one final detail that few see. More than the right gains, what determines long-term success is the errors avoided. And it is exactly about this that we will speak next. Buffett has stated that he has gained more by saying no than by hitting brilliant ideas. For him, avoiding bad investments is as important as finding good opportunities. This philosophy, as simple as it may seem, is the opposite of what most investors practice, and it is precisely for this reason that it works. In a study conducted by the University of Berkeley, researchers analyzed the behavior of individual investors over several years. The result was clear. The more they traded, the lower their returns. Excessive confidence led to impulsive and poorly calculated decisions. Buffett elegantly simplifies the rule. If you cannot explain in one sentence why you are buying, do not buy. It seems obvious, but think about your portfolio. How many assets have you bought because you truly understood them? And how many were acquired due to the influence of videos, forums, or the urgency of not missing out? It is precisely this rational and self-aware perspective that Buffett has followed for decades. However, he does not stop there. There is an even deeper reason why he prefers discipline over action. Buffett nearly invested billions of euro and decided not to. This choice, grounded in discipline and clarity, says more about his philosophy than any significant success. He knows that in investing, the true power lies in recognizing when not to act is the best decision. Like this video, subscribe to the channel if you value this content showcasing long-term strategies. See you in the next video.